Hello, this is Corner Invest. Today I'll be analyzing all the different Max 7 stocks as well as the risk to reward for all these different stocks over here. The first stock that we'll be starting with is Google. So Google is a company that is basically currently trading at a 19 times earnings, around a 18 to 17 times forward earnings, and overall the company is down around 25% year to date. So for this business over here, there are multiple different risks associated with it. You have your ChatGPT risk, whereby all your different LLMs, they are starting to take over market share from Google. That is basically what the streets are talking about right now. You have another problem, which is capex risk. So Google is projected to spend about 75 billion in capex this year. And yeah, if this capex leads and this capex continues increasing over time, then you will see a lot of depreciation in the company's earnings and income statement. So for this business over here, if you have to just look at the valuation of the business, currently Google is trading at around 20 times earnings. So let's say it holds the multiple at a 20 times earnings. Google's EPS right now is 8.05, and historically this company has grown well above 15%. So assuming this company grows at around a 15%, at the current stock price today, it gives you around a 15% CAGR. So it's basically market beating returns at a 20 times earnings. So Google is trading at a 19 times earnings when you have the market trading at 24 times earnings. So I think Google right now is presenting an asymmetrical bet. And that's why for me, Google is a strong buy in the markets today. Even though it is up around 10% in the past few days or so, I think Google is still one of the strongest businesses out there. And in the long run, if AI is here to stay, then the distributors of AI will be the winners in the game. And Google will be the company that is basically able to distribute the most AI because they have the most database and the most user base in the entire world. And they are the company that is able to distribute all your different AIs and basically package everything together, sell it at the best deal to all your different customers. So that's why Google is in a strong buy category for me today. And yeah, I think it's an asymmetrical bet at this point. Next company is Meta. So Meta recently faced a lawsuit by the FTC. The FTC are claiming that Meta is having a monopoly with its Instagram and WhatsApp companies as well. And so for Meta over here, it is currently a company trading at around 22 times earnings. And overall, I think Meta is a decent company as well, similar to Google. Although it doesn't have as much of a moat as Google, because Meta is a pure advertising play. In a bull market, in a economy that is doing well, Meta will do very well. But in a downturn economy, when everyone starts to cut spending, then Meta will start to see its earnings get hurt. So this tariff news over here has indirectly harmed Meta's earnings because Meta's advertising space is usually for dropshippers, for small businesses, whereas for Google, it is for large conglomerates and large businesses. So for Meta over here, it is less resilient to economic downturns. And if this tariff persists, then all your different small businesses will get hurt and then they start spending less on advertising. That's one risk for Meta. Another risk for Meta is the capex spending as well. So for all your different companies, it's similar to Microsoft, Amazon as well. They are spending too much money on capex, in my opinion. And if they don't get a return on investment on all this different capex spending, then they could see their earnings getting hurt in the future. Currently now we're only seeing it in the cash flow statement because the cash flow statement shows it as a one-time expense in terms of the capex. But for all this capex in the future, it could lead to a lot of depreciation, which could lead to some form of earnings decrease over the next few years. So this is the way that the US they do their accounting, and that's why we could see earnings getting hit in the future if the capex doesn't pay off. So for Meta over here, trading at a 22 times earnings and trading at a 21 times forward earnings, I think this company is a decent company right now, trading at a decent valuation, and that's why it's in a buy category for me. I don't think Meta is trading at a premium to the markets at all. In fact, it is trading at a discount to the markets. And so overall, I think Meta is a decent buy today if you're looking to start a position. Overall, Meta is a strong company. It's in a buy category for me today. It is much more resilient than it was a few years back, and I just underestimated Meta all these years as it continued building its social media empire. Next company is NVDA. So NVDA is a company that is trading at around a 38 times earnings today. At one point, it was trading at around 32 to 33 times earnings a few days back, and currently now it's trading at a 38 times earnings. So for NVIDIA over here, you've seen an explosion in terms of its earnings after the AI chatbot came out in the form of ChatGPT as people started piling up on all these different GPUs. But if you were to just look at Amazon's Andy Jassy shareholder letter a few days back, he started talking about how AI can be a lot cheaper and a lot more efficient. And then you have DeepSeek as well, which came out earlier this year, which showed how much cheaper AI can get and how much more efficient AI can get as well. So for NVIDIA over here, it has margins of around 60%. I expect that margins to fall over time. And I don't think NVIDIA has as strong of a moat as all these other Mac 7 companies over here combined. So for NVIDIA, it is a company that I wouldn't buy personally and I wouldn't sell if I were holding this company, because this company is projected to grow quite massively over the next few years. I believe around a 30% over the next few years or so. So for NVIDIA over here, if you believe that this capex spend can keep continuing over time, then NVIDIA is a strong buy because it is trading at a very good valuation. But for me, I don't think NVIDIA will be the winner in the entire AI space. I think it will be the distributors of AI that will win the most. All NVIDIA does is it commoditizes its products. It will only be able to compete on price in the future when everything produces the same efficiency. So that's why for me, NVIDIA is in a whole category. It's not a strong buy, it's not a buy as well, neither is it a sell. Next company is Amazon. Amazon is a company trading at 32 times earnings, and the main risk for Amazon is just the tariff risk as well as capex spending. So capex spending, like we talked about earlier, leads to a lot of depreciation. But for Amazon over here, it is a company that is affected by tariffs. So they've started talking to third-party sellers on basically understanding the situation and helping them as these tariffs come into effect. And Amazon has around 50% of its third-party seller services from China itself. So you could see a lot of impact for Amazon if the tariffs come into effect, and it has around 60% of its revenue still coming from retail. And so for Amazon today, if these tariffs continue on and on and on, you could see a company that will be massively hurt by tariffs. But I'm not concerned, I'm not bothered, because Amazon is a high quality business, and if you were to just look into the operating income for Amazon, around 67% of its operating income comes from AWS. So AWS is not hurt by tariff by any means. AWS is the leading cloud provider in the entire world. And for Amazon over here, assuming they earn zero money from retail, it is still a business that is trading at a discount today. And that's why for me, Amazon, it's currently a strong buy. For me, Amazon is the best company out of this list over here in terms of the risk to reward over the next few years. And so I think Amazon today is a strong buy because, yeah, this company, based on its valuation, so let's take a look at the valuation for Amazon. Let's say Amazon trades at around a 30 times earnings, which is a historical low as compared to its past. Its current EPS now is around 5.53, and then assuming a 15% EPS growth over the next few years, at its current price today, Amazon will give you around a 13% CAGR over the next few years. But of course, this EPS estimate is on the low side. Analysts are projecting around a 20% over the next few years. And if you're to just play around with the numbers, if you increase the margins here and there by 1-2%, it is extremely, extremely achievable for Amazon. And that's why I think Amazon is a strong buy for me. I'm not so bothered about the tariffs. In fact, the tariffs can just come and then I'll just buy this company at a discount. And yeah, Amazon is a strong buy today. Next company is Apple. Apple is currently a company trading at 31 times earnings, and the main risk for Apple is simply just a lack of growth, lack of innovation, and just stagnation. So if you have to just look at the fundamentals of Apple itself, the revenue has been flat for a few years already, and Warren Buffett, the biggest super investor in this entire world, has been aggressively selling Apple. They cut their stake by around 60% in the past few quarters already. So for Apple over here, it is a company that has high valuation, low growth, and the only thing that is holding up the stock right now is because everyone loves their products, everyone loves their iPhone, everyone loves their iPad, iMac, everything. And even the products that I'm using now today is from Apple. So Apple, for me, it's in the I wouldn't say it's a hold. For me, I would put it in the sell category simply because the valuation doesn't make sense. And if you're to just think about tariffs as well, if tariffs come into effect, a lot of these China products sold in China will be affected as well. And you could see your iPhones in China going up 20, 30, 40% or so. And everyone is thinking that Apple won't be affected by your tariffs because the US will basically lead on to some exemptions on iPhones coming in from China. But what if the Chinese government don't reduce the tariffs on these iPhones in China? Then you could see a lot of price increases in China itself, which could hurt the China sales. And the China sale is actually one of the largest portions in Apple entire revenue category. And so for me, Apple, it's an avoid, it's a sell. I wouldn't touch this company. And yeah, the valuation doesn't make sense for now. Unless it goes all the way down to $120, $130, then that will be a buy price for me for Apple. Next company, Microsoft. Microsoft is currently a company trading at around 30 times earnings and around 27 times forward earnings. And for Microsoft, A few risks over here. The main risk I'm seeing from Microsoft is simply just the capex spend. I don't see any risk apart from that portion. It is a durable business that has been able to grow its revenue, grow its earnings throughout hard times as well. If you were to look at 2020, 2022, this company has been able to increase its revenue over those 2 years as well. So for Microsoft over here, if you were to just look at the valuation itself, assuming a 26.4 times earnings, which is the lowest point in the past few years, over the past 5 years, and assuming a 13% EPS growth for this company is currently now trading at around fair value, I would say, around a 10% CAGR, which is market returns. And so for me, I think Microsoft is a buy today. It is not a strong buy. It is not extremely undervalued. It's simply a all-weather stock. It's a buy and hold forever stock. You just buy it, hold it, and then just never sell it. And then it will just keep compounding and compounding and compounding all these years. And yeah, it's an extremely durable business that I can see 10, 15, 20 years from now. Because no one is going to replace your Windows OS. No one is going to replace your Microsoft 365. No one will replace Azure because Azure is bundled with Microsoft 365. So Microsoft is a buy today. Last company is Tesla. So Tesla is a company that is trading at around 124 times earnings. And yeah, for Tesla today, it is a company that is trading on stories. Doesn't make sense to buy into this company if you're a fundamental investor, if you're a value investor, because the company is detached from its fundamentals. It is trading all on stories. It is trading on sentiments. So yeah, if you're to just look at the valuation for Tesla, for example, the current stock price is around $240. Assuming a 50p for this company and assuming they grow around 20% or 30% over the next few years, that is only a 10% return for this company. That is assuming a 30% growth and a 50% price to earnings for this company. And so for Tesla today, I think it is in a sell. Tesla shareholders are more concerned with the story. They're not concerned with fundamentals at all. You could see these companies losing and basically missing every single metric in their earnings and still run in the earnings call because Elon Musk will say something about robo-taxi and then the stock starts to moon again. So for Tesla, I'm a value investor. I don't think Tesla is a company that I would ever invest in, maybe for a trade. Hopefully this video has been useful for you, and invest safe.